How to determine business nexus for state income tax. Imagine running a business that sells products online or has employees in different states. How do you know which states can tax your income? That's what we're here to figure out. Understanding where your business has a connection, called nexus, is key to knowing your tax responsibilities. First, think about whether your business has a physical presence in a state. Do you have an office, a store, a warehouse, or manufacturing equipment there? If yes, that usually creates nexus. Also, if you employ people or have representatives working in a state, that can establish nexus too. It's like having a foothold in that location. Next, consider economic presence. Even if you don't have a physical location, some states say if you make a lot of sales or generate a certain amount of revenue in their state, you have nexus. For example, if your online sales in California go over $500,000 in a year, California might say you owe income tax there. This is called economic nexus, and it's become common across many states. Another factor is whether your employees, agents, or independent contractors are actively working in a state. If they are soliciting sales, providing services, or doing business activities regularly, that can create nexus. It's not just about having a person there once, but doing ongoing work. States also look at whether your business is engaging in regular or systematic activities. If you are consistently doing business in a state, even temporarily, that can establish nexus. For example, if you attend trade shows, run marketing campaigns, or have a storefront open for several months, these activities count. With the rise of online shopping and remote work, digital presence is now important. If you sell digital goods or services to customers in a state, or have remote employees working from there, many states consider that enough to create nexus. It's like your business has a virtual footprint. There are some exceptions, too. Under federal law, if your only activity is soliciting orders for tangible personal property, and you do not have a physical presence or substantial economic activity, you might be protected from nexus. This is called Public Law 86-72, and it limits states' ability to tax certain businesses. Once you establish nexus, you usually need to file a state income tax return and pay taxes on income earned in that state. Because rules differ from state to state, it's important to check each state's specific thresholds and definitions. For example, some states set the sales revenue threshold at $100,000, others at $500,000. For Asian American business owners operating across multiple states or selling online, understanding nexus is especially important. It helps you stay compliant and avoid penalties. Consulting with tax professionals familiar with state rules can make this process easier. In short, to determine if your business has nexus for state income tax, look at your physical presence, economic activity, employee activity, and digital footprint in each state. Then verify whether those activities meet that state's specific rules. Staying on top of this ensures you're paying the right amount of tax where you should.